think you know what it means to save money. You see it as a quiet, responsible act. You transfer a bit of your paycheck into an account, watch the number go up, and feel a sense of security. But what if I told you that this simple act is the end result of a brutal multi-thousand-year history of panic, revolution, and betrayal? What if I told you that the very concept of your savings account is built on an illusion that has collapsed time and time again, wiping out the wealth of nations? This isn't just a story about finances. It's a story about the evolution of trust itself. We're about to peel back the layers of history and reveal the 5 critical moments that completely shattered and then rebuilt how humanity protects its future. From a simple clay pot buried in the dirt to the invisible, high-stakes world of digital code, each shift solved one problem while creating a newer, more dangerous one. And the patterns from these ancient collapses are repeating themselves right now in ways that could determine the future of your wealth. Stay with us, because understanding this story isn't just a history lesson, it's an essential guide to surviving the next great financial shift. Shift 1. The earthen vault. When your life savings fit in a pot. To find the origin of saving, you have to forget about money entirely. Imagine a world governed only by seasons. Your wealth wasn't in coins. It was in the grain from your harvest, the seeds for the next planting, the dried meat for the winter. Saving wasn't for a vacation. It was the line between life and death. The origins. In early agricultural societies, the first savings account was brutally simple: a hole in the ground. You would dig a pit, line it, store your surplus grain, and seal it against pests and rot. This was the purest form of saving, a direct physical act of deferring consumption for future survival. The individual was in complete control. The rise. As societies evolved, so did the technology. The pit became a clay pot, a more durable, portable, and secure vessel. When the first coins of gold and silver were minted, these same pots became the world's first piggy banks. People buried their life savings in their homes or fields. This was the golden age of personal financial sovereignty. Your wealth was your secret, protected by your own ingenuity and muscle. The breaking point. This system, for all its simplicity, was incredibly fragile. Your security was an illusion. A flood could wash away your hiding spot. A fire could destroy your home and melt your assets. A rival tribe or a greedy warlord could conquer your land and take everything. More importantly, this wealth was stagnant. Buried gold can't be used to build a mill, fund a trading voyage, or stimulate an economy. It was dead capital, a bottleneck that choked the growth of civilization. The fallout and failed fixes. The consequence was that economies remained small and localized. Trust didn't extend beyond the village. The only fixes were incremental: a stronger box, a deeper hole, a more clever hiding place. But these couldn't solve the fundamental problems of physical risk and economic stagnation. Humanity needed a way to make its savings both safe and productive. And that required something that seemed unthinkable: giving your wealth to a stranger. Shift 2. The goldsmith promise, the birth of the bank and its original sin. In the bustling, chaotic cities of the late Middle Ages, a new problem emerged. Merchants and nobles had more gold and silver than they could safely hide in a pot. Carrying it was a death sentence, and their homes were vulnerable. They needed a protector, someone with vaults, guards, and a reputation to uphold. They found one in the local goldsmith. The origins. Goldsmiths already had the necessary infrastructure to protect their own valuable materials. Seeing an opportunity, they began offering a service. They would store other people's gold in their vaults for a fee. In return, they gave the depositor a piece of paper, a receipt promising the return of their exact gold on demand. The rise. This simple receipt accidentally changed the world. Merchants soon realized that instead of going through the hassle of withdrawing gold to pay for goods, they could just trade the paper receipts instead. The receipt was as good as gold, but far more convenient. This was the birth of the banknote. But then, the goldsmiths had a second, more profound realization. They noticed that on any given day, only a small fraction of their depositors came to withdraw their gold. The rest of it just sat there. So they started lending out the gold they were supposed to be storing, charging interest and making a profit on other people's money. This evolved into an even more powerful idea. They could simply issue more receipts than the gold they held in their vaults. This practice, known as fractional reserve banking, was the moment the modern banking system was born. They were in effect creating money out of thin air, backed only by a promise. The breaking point. The entire system rested on a fragile foundation of public confidence. As long as everyone believed their receipt was good for gold, the system worked. But what happened when a rumor spread that a goldsmith had made bad loans or was on the verge of collapse? A bank run. A terrified mob of depositors would descend on the shop, all demanding their physical gold back at the same time. The fallout and failed fixes. The goldsmith couldn't pay. The system shattered. The receipts became worthless paper, and people's life savings vanished in an instant. This cycle of boom, panic, and bust defined early finance. Early fixes were futile. Stronger vaults and more guards couldn't stop a crisis of confidence. The fundamental flaw was that the power to create and risk money was in the hands of unregulated individuals. The scale of the collapses became so damaging that a higher power had to step in. Shift 3. The state's monopoly. When money became a national promise. The chaos of private banking panics was unsustainable. Nations couldn't fund wars or build infrastructure on a financial system that could evaporate overnight. So governments made a historic move. They decided to monopolize the business of trust. The origins central banks like the Bank of England were established. The state took over the exclusive right to issue paper money. At first, this money was still a promise to pay in gold or silver, a gold standard. But the trust was no longer placed in a local goldsmith, but in the military and economic power of the entire nation. The rise. This created unprecedented stability. A pound was a pound and a dollar was a dollar anywhere in the country. Commerce flourished. The government also established regulations and, crucially, deposit insurance. This was a psychological masterstroke. Even if your individual bank failed, the government guaranteed your savings were safe. For the average person, saving money had never felt more secure. You could put your cash in a bank and sleep soundly, knowing it was backed by the full faith and credit of your country. The breaking point. The state solved the problem of private bank runs, but it created a new, more insidious threat. The government now had total control over the money supply. What would stop them from printing more money to pay for wars, social programs, or to cover their own debts? The answer in many cases was nothing. When the supply of money increases faster than the production of goods and services, the value of every single dollar you've saved decreases. This is inflation, a quiet invisible tax on your savings. The fallout and failed fixes. In extreme cases, this led to hyperinflation. In 1920s Germany, people had to haul wheelbarrows of cash just to buy a loaf of bread. Savings accumulated over a lifetime were rendered worthless in a matter of months. This has been repeated throughout history, from ancient Rome to modern Venezuela. The promise of the state proved to be just as fragile as the goldsmiths, just on a grander scale. Failed fixes like price controls or issuing new currencies were merely cosmetic, failing to address the core issue of fiscal discipline. A new financial mindset was needed. Shift 4. The growth imperative. When saving was no longer enough. By the mid-20th century, people realized that letting their money sit in a government-backed account wasn't enough. Due to inflation, money that wasn't growing was actively shrinking in value. The goal shifted from mere preservation to active growth. The origins. While interest is an ancient concept, the post-World War II economic boom saw the widespread popularization of financial products for the masses. The magic of compound interest was marketed as the key to a prosperous future. The idea that your money could work for you, generating more money while you slept, became a cornerstone of personal finance. The rise. This sparked the democratization of investing. The financial world, once the exclusive playground of the ultra-rich, opened up. Mutual funds, retirement accounts like the 401k, and accessible stock trading allowed ordinary people to buy a piece of the economy. The mindset shifted. Saving was no longer just for a rainy day, but for long-term goals like retirement and education, funded by the power of market growth. The breaking point. This new paradigm swapped the risk of inflation for a different beast. Market risk. Your savings were no longer a stable number in a passbook. They were tied to the volatile and often irrational behavior of financial markets. The new bank run was the stock market crash. Events like Black Monday in 1987, the dot-com bust of 2000, and the global financial crisis of 2008 showed that decades of accumulated savings could be wiped out in a matter of weeks. The fallout and failed fixes. Each crash shattered public confidence in the financial system. Millions saw their retirement plans evaporate. In response, governments enacted new regulations and bailed out institutions deemed too big to fail. But these fixes couldn't eliminate the inherent risk. The low interest rate environment that followed the 2008 crisis also meant that the safer savings accounts now paid next to nothing, pushing people toward even riskier investments to get any return. Trust in the entire centralized system of banks and governments began to fray, setting the stage for the most radical shift yet. Shift 4. The growth imperative. When saving was no longer enough. By the mid-20th century, people realized that letting their money sit in a government-backed account wasn't enough. Due to inflation, money that wasn't growing was actively shrinking in value. The goal shifted from mere preservation to active growth. The origins. While interest is an ancient concept, the post-World War II economic boom saw the widespread popularization of financial products for the masses. The magic of compound interest was marketed as the key to a prosperous future. The idea that your money could work for you, generating more money while you slept, became a cornerstone of personal finance. The rise. This sparked the democratization of investing. The financial world, once the exclusive playground of the ultra-rich, opened up. Mutual funds, retirement accounts like the 401k, and accessible stock trading allowed ordinary people to buy a piece of the economy. The mindset shifted. Saving was no longer just for a rainy day, but for long-term goals like retirement and education, funded by the power of market growth. The breaking point. This new paradigm swapped the risk of inflation for a different beast, market risk. Your savings were no longer a stable number in a passbook. They were tied to the volatile and often irrational behavior of financial markets. The new bank run was the stock market crash. Events like Black Monday in 1987, the dot-com bust of 2000, and the global financial crisis of 2008 showed that decades of accumulated savings could be wiped out in a matter of weeks. The fallout and failed fixes. Each crash shattered public confidence in the financial system. Millions saw their retirement plans evaporate. In response, governments enacted new regulations and bailed out institutions deemed too big to fail. But these fixes couldn't eliminate the inherent risk. The low interest rate environment that followed the 2008 crisis also meant that safe savings accounts now paid next to nothing, pushing people toward even riskier investments to get any return. Trust in the entire centralized system of banks and governments began to fray, setting the stage for the most radical shift yet. Shift 5. The Code of Trust, the promise and peril of digital money. Born directly from the ashes of the 2008 crisis, a new ideology emerged. What if we could build a financial system that didn't rely on fallible banks or self-interested governments? What if we could replace human promises with the cold hard certainty of mathematical code? The origins. In 2009, the anonymous creator of Bitcoin released a white paper for a peer-to-peer electronic cash system. It used a technology called blockchain to create a decentralized, transparent, and immutable ledger. For the first time, you could save and transact value without needing any intermediary. You could truly be your own bank. The rise. This idea exploded into the world of cryptocurrency and decentralized finance, DeFi. It offers a radical vision for saving. Your assets are held in a digital wallet that only you control via a cryptographic key. You can lend, borrow, and earn yields that can dwarf traditional banks, all on a global, permissionless network. For many, especially those living under unstable regimes or disillusioned with the traditional system, this represented the ultimate financial liberation. The breaking point. This absolute freedom comes with absolute responsibility. The world of crypto is an unregulated frontier plagued by terrifying volatility. Your life savings can double in a month and then fall by 80% the next. Worse, there is no safety net. No deposit insurance, no government bailout. The bank runs of this new era are the collapses of massive crypto exchanges like FTX or lending platforms like Celsius, where billions in user savings were locked, lost, or stolen. The fallout and failed fixes. If you lose your private key, your money is gone forever. If you fall for a scam, there's no fraud department to call. The fallout has been a string of catastrophic losses for millions of retail savers who were promised a new, better system. The failure of decentralized crypto companies, ironically acting much like the unregulated goldsmiths of old, has shown that technology alone doesn't eliminate greed and mismanagement. The system is now at a crossroads, with users and developers trying to build more resilient systems while governments move to impose control. Conclusion. The echoes of history in your wallet. So, where does this leave us? From a clay pot to a string of code, the history of saving is a cycle. A problem appears, a solution is invented, and that solution creates a new, often more complex problem. The patterns are undeniable. Takeaway. 1. Diversify your trust. History's clearest lesson is that no single system is infallible. The earth can betray you, the goldsmith can fail you, the state can inflate away your wealth, the market can crash, and the code can be hacked. A truly resilient savings strategy doesn't put its faith in just one system. Takeaway 2. Know what backs your savings. Is your money backed by a physical asset, a government promise, the future profits of corporations, or a decentralized algorithm? Each has a different strength and a different breaking point. Understanding this is the most critical part of financial literacy. Takeaway 3. Security is never passive. Whether you're choosing a hiding spot for your gold or securing the private keys to your crypto wallet, protecting your wealth has always been and will always be an active pursuit. The belief that you can simply set it and forget it is an illusion that history has repeatedly shattered. We are now entering a new era with the rise of central bank digital currencies and AI-managed finance. These technologies promise unprecedented efficiency and security, but they also offer the potential for unprecedented surveillance and control. Will this next great shift finally solve the eternal trade-off between safety, growth, and freedom? Or will it simply be another turn of the same historical cycle? The story of saving is far from over. Your financial decisions today are a part of it. What do you think is the biggest risk to our savings today? Is it inflation, a market crash, or something new on the horizon? Share your thoughts in the comments below. And if this journey through financial history gave you a new perspective, please hit the like button and subscribe to the channel for more deep dives that connect the past to your present. Thanks for watching.